Welcome to Private Capital Call, the podcast with leaders in asset management, investing, and capital markets. I'm your host, Randy Schwimmer. Our guest today is Anastasia Amoroso, Chief Investment Strategist at iCapital. She provides valuable insights on private and public market investing opportunities for advisors and their high net worth clients. Anastasia, it's a pleasure to have you with us.
Good to see you, Randy.
So you've put out a couple great research pieces recently, including your market outlook entitled Solid Underpinnings and Plenty of Wildcards. I love that title. And you heard Ken outline the macro issues a year ago that then you would have called headwinds. So inflation, high rates, slowing economy potentially, but today feel like tailwinds. What are the wild cards for 2025 and what should investors be aware of?
Right. Well, Randy, you're right. We've come a long way on things like inflation and central bank policy. But, having been investing for a long time, you and I both know that there's always a set of headwinds, this wall of worry that you climb. And so this year is not different. But I would say what's unique about this year is that a lot of these wild cards are centered around policy uncertainty. And so we have to think about taxes. We have to think about tariffs, budget deficits. What might the Fed do in light of inflation, if it's going to ease or not? And then finally, big tech regulation. And, I call them wildcards for a reason, because it's possible that the outcomes may be favorable. We get tax cuts, but none of the bad stuff that comes with it. We resolve the budget deficits favorably with the markets, and we're not actually going to have big tech scrutiny. But I will say the other part of that is also possible. For example, tariffs can be massively disruptive for the economy, and perhaps inflation doesn't ease as much as expected, and perhaps the Fed doesn't actually cut rates, or maybe they even hike. So those are the wild cards that you have to consider. But I will say that first part of the outlook is the solid underpinnings. That's what gives me optimism for this year, and that's what makes me constructive on risk assets, because the economy had very solid momentum from the tail end of last year. That's carrying it over to this year in terms of consumption, for example. But it's not just the familiar, the U.S. consumer is strong story. I think there's several factors that are further supporting the economy, which is the rebound in capital markets activity that we expect, the deregulation that investors are looking forward to. And this is probably very little talked about, but the increase in productivity that we're witnessing and the fact that productivity has grown by 2.1% on average in the last 5 years, which is a big step up versus the prior 5 years. And artificial intelligence, I think, is just starting to bear fruit. So there's lots more of that to come. But when I put all those things together, solid underpinnings and plenty of wild cards, I think what this means for investors is, yes, we're constructive, but we do expect a wider distribution of outcomes. And with that, we might potentially get more volatility or periods of volatility throughout this year versus last year.
So more volatility. So in light of that, which we haven't had of late, what is the implication from your perspective on asset allocations? What should investors be thinking about that's different in the year to come?
Right. I think one of the implications of higher volatility is that the diversification from public to private markets. And just to, again, put the volatility into context, if you think about the first Trump presidency in 2017, it was wonderful for markets in terms of returns and in terms of low volatility. In 2018, we had a different scenario where markets didn't fare as well and volatility was averaging 18 versus 11, and then in 2017 here. And what you find is that volatility really follows the policy uncertainty. So against that backdrop, the 60-40 portfolio might do okay, but I think it's very reasonable to have a piece in your portfolio that doesn't get whipped around with the whim of policy, with the whim of public markets. And when you look at a 15-year chart, for example, Randy, and you plot the 60-40 portfolio, here's your volatility, here's your return, you'll really find that most of the private market asset classes have delivered higher risk-adjusted returns, higher return, and lower volatility. So there is a historical case to be made there. And, then this year in particular, if we do get a rebound in capital markets activity, that should bode quite well for private equity. And if we don't get further rate cuts, that actually further supports an opportunity in private credit. And maybe the last point, yes, alternatives I think make incrementally more sense this year, but I think also for investors looking out over a 10-year time horizon, on average over the next 10 years, we expect about 250 basis points of outperformance in private equity versus public. And on average, about 340 basis points of outperformance of direct lending versus the public fixed income. So yes, alternatives are good for this year, but it's certainly a longer term opportunity as well.
Well, to your point, we did a survey recently of our investors, which showed an amazing 98% of respondents indicating they were looking to either maintain or increase their exposure to private credit. 60% saying they would do that regardless of rate direction. So it does seem like the long-term fundamentals of private credit are pretty firmly in place.
I think that's right. Investors may look at this long-term expected returns. They may look at the yield advantage that private credit has versus high yield or leverage loans or other places within public market. And I think investors also look at the fact that if you look at the last 17 years worth of history for private credit, there's 1 year that resulted in a negative return. And that year was 2008. And the return was down about 7%. So you do have history once again on your side, but I almost think that sentiment is very well supported, that maybe it's not just the evergreen structure of private credit, but it's the evergreen solution. Because I remember back in 2022, as we worried about inflation and growth and equity markets, we talked about private credit being the place where you get paid while you wait out that public market volatility. In 2024, at certain points, we worried about, well, maybe the Fed is not going to cut rates. What do you do? Well, that's once again when you look to private credit, because it does give you that significant yield pickup, and certainly a yield pickup over Fed funds rate. So it just might be one of those evergreen solutions. And from our survey numbers, or rather our flow of funds on the iCapital platform, we see that demand for private credit being very consistent and actually pick up. Let's say low 30%. That's what was going to private credit from all the flows on the platform a couple of years ago. And now 37 to 39% of our flows are going into private credit. So I think investors do agree.
Yeah. So and our experience is that in the core direct lending market that we play in, that investors are now firmly embedded in that. But they're also now looking for other things within private credit to explore, to diversify their exposure, to your point, in the alternative space. And it seems like asset-backed finance is the new kind of bright, shiny thing. Why is that? And how should investors be looking at any kind of collateral-based asset strategy?
Well, you're absolutely right. It is the part of private credit that more and more GPs and more investors are discussing. And let's just talk about what is it actually? What is asset-backed finance? And think about it as an investment that invests in a pool of cash flows from some sort of contractual asset. And that asset may be a consumer asset. It may be an auto loan. It may be a mortgage loan. That asset may be a corporate asset. Maybe it's an airplane and there's a lease associated with that. Maybe it's a piece of equipment and there's a lease that's associated with that. So it's really about pulling those cash flows and allowing investors to benefit from those. So as new as this might seem to some investors, it certainly is not new. And in fact, when you size up the asset-backed finance market today, it's about $5.5 trillion, give or take. And by the way, that is more than the size of high yield leverage loans and actually direct lending combined. So it's not a niche market by any means. And it is forecasted to grow to $7.7 trillion in a couple of years. But when you really think about the total addressable market, it's about 30 trillion. So I think that's why you hear more and more of that conversation, because banks are not the lenders they used to be, not just to corporations, but also to some of these types of loans. So we do see an opportunity there as well. And actually for 2025, asset-backed lending, asset-backed finance is one of our top ideas, because when you think about that solid underpinning for the U.S. economy, that benefits the consumer, it benefits maybe the aviation industry, it benefits the music royalties. And so we feel good about the return profile and not having to be as concerned about delinquencies there.
That's super helpful. Thank you. So as we wrap up this segment, thinking about 2025, but also looking back on 2024, I'd be curious what your biggest surprise, and there may be a number of them, but if you could just tell us for last year, what surprised you the most about the markets or frankly anything? And then thinking about 2025 going forward, if when we sit in these chairs next year, and I ask you what was the biggest surprise of 2025, what would you say? So let's think about last year first.
Last year, I think the biggest one for me was how long it actually took to cut interest rates. Because when you came into the year of 2024, I could have made the case for the first rate cut to be in March. Of course, that was not what happened. And in fact, when March came around, people were talking about the Fed potentially raising rates to 6%. Well, thankfully, that never happened. But it really took until September of last year to have that first rate cut. And what really strikes me, and maybe that's the lesson learned, is how volatile the path has been. And you really can't, whether you're an investor or the Fed, kind of pre-commit to the path of Fed fund policy until you see the data, until you see the development. So I think we have to carry this into this year as well. And at the moment, the markets are virtually writing off any possibility of rate cuts this year, but I wouldn't pre-commit to that.
Interesting. And how about 25?
And 25, look, there's some wild cards, there's some high expectations. And I would be surprised, and perhaps pleasantly surprised, if we manage to deliver the tariff agenda that the Trump administration, I think, is very much going to pursue without disrupting the economy, without stoking inflation, without trade wars and retaliation that would, for example, hurt manufacturing and other sectors. I would be pleasantly surprised by that. So we'll see.
Look forward to next year when we recap and see if you were right. Anastasia Amoroso, iCapital's Chief Investment Strategist, thank you so much for being with us.
Thanks, Andy.